Well, welcome once again to the Maximum Performance webinar series. Today's event, I am joined by my good friend and colleague, Mr. James Charlet. He is the former executive legal counsel from Experian. He has been one of the premier educators in the area of credit and how to help customers manage their credit for better results when it comes to what's really causing problems in a borrower's credit score. So today's program is really focusing deep on just one of the nuances in the scoring algorithms that cause problems that mean a borrower who's otherwise a good and honorable borrower who tries to pay their bills on time that should have a 660 FICO ends up having a 560 FICO, and we can't get them a good loan at a good rate. There's a lot of myths and misconceptions. There's a lot of people out there who think they know everything about credit, and I'll tell you, my first experience meeting James was about 4 years ago. We were speaking at a conference together, and I literally, sitting through 45 minutes of James' presentation, learned more in that 45 minutes than I did a year before in a 2-day credit understanding, credit scoring workshop that was put on by Equifax. And so I'm pleased and thrilled, backed by popular demand, to have Mr. James Charlet share with us today. He's going to go through a program talking about the myths and misconceptions of credit score and what we really need to know to help our borrowers get those loans. Now, there's one thing that I want to make very, very clear as we get started. We are not talking about illegal credit repair of the 2008 and previous era. We are talking about accurately investigating and correcting legitimate inaccuracies in the credit bureau, and where a scoring because of a miscoding or a mislisting is altering the score much more dramatically than it should. At the end of the day, guys, lying to the credit bureaus is essentially mortgage fraud. When you're suppressing, omitting, or altering information for the purpose of obtaining a loan, that is in fact mortgage fraud. That's not what we're talking about doing here. We're talking about helping customers legitimately investigate and correct the real inaccuracies that are arbitrarily and unfairly negatively impacting their credit scores. And so with that further ado, guys, I'm going to turn this over to James. James, I know you've got a ton of information to share with us in just a brief period of time here, so I'm going to let you take it and run with it, all right?
Yeah, absolutely. Thanks so much for the intro, Eric. Again, good morning, everybody. Looking forward to some great questions today. I'm going to say it again, same thing Eric said. I do love to be interrupted. I love this to be interactive. You can't kind of throw your hand up or scream at me in this format, but we do have that question and answer box over there, and the more questions that go in there, a lot of times I feel, especially the better the experience is. So feel free to ask me whatever you want as we move through here. Just talk a little bit about myself. I know that's the most boring topic for you, but just kind of want you to understand, Eric mentioned that I was part of the legal executive team at Experian, legal compliance, what that was called is CAS, Consumer Affairs Special Services. What I handled there, what the department handles, is basically all high-level consumer affairs, public relations. We handle inquiries from Congress, from the FTC, from attorney generals, both state and federal. From the BBB, any executive correspondence. So if somebody is, threatening to sue, at the time Don Roberts was the CEO, he's now the chairman of the board for Experian. Anything where they're threatening to sue him directly goes through our department. So as you can imagine, we were some of the most reviled individuals within Experian, but it taught me, as you can imagine, a whole lot. Experian at the time I was there was a subsidiary of a conglomerate out of London called Gus PLLC, 600,000 global employees. They were willing to put me on the stand to be a witness as an expert on the Fair Credit Reporting Act. So, they believed that I knew what I was talking about when it came to credit. So hopefully after this, you will as well. So, obviously when I was there, I hated credit repair. I still don't like the word credit repair. I still know that there's a lot of problems. As Eric alluded to, it is illegal to lie to a credit reporting agency. Making misstatements under the Fair Credit Reporting Act is technically a federal offense. You're not supposed to make misstatements then. However, the reason I left Experian, what I saw was a whole lot of either by proxy or deliberate obfuscation, where consumers don't know their rights, they don't understand how to tell if something's reported accurately, they don't understand how credit scores work. Even professionals in industries that directly depend on it quite often don't have a full grasp of how it works. And when Eric talks about that 2-hour session he was at from Equifax, I believe there's some deliberate intent there to make it more difficult to understand and make it where you just kind of go, well, the heck with it, I'm not going to bother them anymore. I'm just going to live with how this is. Well, I didn't think that was right either, and I saw so many high-level disputes. I mean, every day at Experian, we were getting sued, actually being served with paperwork on average 5 times a day, 365 days a year, 250 threats of lawsuit. When I say a threat of lawsuit, I don't mean crazy Uncle Jim threatening to sue. I mean letterhead from a law firm. Wolfowitz and Stern, we're going to sue you. 80 Attorney General complaints, 35 UCC complaints, 10 congressional inquiries with congressmen or senators or asking about the incorrect information directly for their constituents. And of course, the thought that was keeping me up at night is for every one of these people that has the knowledge, the resources, or the wherewithal to go and go to their congressman or hire an attorney or go to their attorney general or even go to the BBB, how many other hundreds, if not thousands of people are just resigned to their fate, and they're not going to go that extra mile. They're not going to be persistent with the errors and misinformation. And so at the same time, I did know that there were a lot of fraudsters and shysters within the credit repair field. And so I felt like if I left Experian, because I just couldn't anymore, I could perhaps help them to see the error of their ways, help the credit repair become a legitimate field, because there's a need for it. Obviously, consumers need to understand the law and be able to correct those errors and understand it properly. Just the quantity of misinformation that's out there, it's very difficult to do. And then at the same time, I want to help consumers. Education and consumer advocacy is really where my passion lies. And so that's a big part of why I'm sitting here right now and working with Eric and talking to mortgage professionals, because, like it or not, even though credit impacts people every day, I have clients that can't get their security clearance in the military because of their poor credit history. There's all kinds of ways. Your insurance, that it impacts you. Most people truly don't think about their credit and really, wonder whether or not their information is correct until they use it. And most people don't truly use it until they're buying a house. And so mortgage and real estate professionals, I also teach a similar class to this for CE credit for real estate professionals in Texas. And real estate and mortgage professionals, you guys are the front line. You're the ones where consumers are depending on you to have the right information when you can give it to them. And there's also those kinds of lines across as well. But when you can give it to them, they depend on you to have the right information. And so I feel like by educating you from an insider's perspective, I'm doing the best possible job I can for consumer advocacy. Now, on the other side of it, obviously, if you think I know what I'm talking about at the end of this, and you do have clients that have these types of errors, and you don't want to have to deal with them, obviously I would love to have your business as well. I have gone into that credit correction field, as we say here. I do not like repair, because repair to me indicates lying. And as Eric said, you cannot lie. You can't say this is theirs. You can't try and get something removed just because they don't want to pay it or something like that. But there's enough errors on the report where people have, collection companies in particular, have misreported ODDs and original creditors and all kinds of misinformation like that, that there's no need to lie to them. And we'll get into some of those errors and some of those things as we go through the class here. So, okay, this is how I from here on out. That's the end of me talking about myself and that. So everybody, if you tuned out for that, you can tune back in now. I'm done talking about myself. What we're going to be talking about right now is what I consider to be the most important 2 concepts when it comes to this entire series. Anything having to do with credit. If you can understand these 2 concepts, then everything else is going to make a lot more sense. And after this class is over, when people come to you, or news organizations put something out that maybe is not 100% the truth, or doesn't fully explain how that concept works, you're going to be able to go, you know what? I understand these two things, so I know that's not correct, okay? Likewise, they say that after this class, you're going to forget 75% of what you learned within 6 months. Well, that other 25%, make sure that this is part of it, okay? So this is the risk and the gray area, okay? We'll start with risk. All of the industries we talk about today, credit reporting, credit scoring, credit bureaus. By the way, first myth dispelled. Experian, Equifax, and TransUnion are not bureaus, okay? They are credit reporting agencies or repositories, data repositories. Bureaus are a totally separate industry. Bureaus are the companies like Kroll or Funding Suite or CBCI Novus. These companies that purchase the data from the credit reporting agencies, score it, and then merge it together and send you a tri-merge bureau report. Well, it's called a tri-merge bureau report because they merged the 3 credit reports, and the bureau sold it to you. So that's, everybody calls Experian, Equifax, and TransUnion bureaus, but they are not. They're credit reporting agencies. Bureaus are a different industry. But nonetheless, all 3 of those industries and my industry, credit services, all exist for one reason and one word. That word is risk. It's trying to answer one question. What is the probability that this person that I lend money to will repay that money to me in a timely fashion? That's it. That's all of these multi-billion-dollar industries, and they are multi-billion. Experian alone did $5 billion almost last year, and that's one of the 3. And then count the bureau's money and the score and how much money FICO makes and Vantage makes. It's multi-billion-dollar industries trying to answer one question. Now, the way they do that a lot of times is with lots of data, lots of math, lots of forecasting, lots of predictions, but it really comes down to a couple very simple things. You have to have credit so they can measure you, and if you pay your bills in a timely fashion and they're reported accurately and you don't miss payments and don't get collections, your score goes up as you build more positive credit. If you do things that are irresponsible, and at least through the eyes of the credit scoring firm, your score goes down. Responsible behavior makes your score go up. Irresponsible behavior makes your score go down. Neutral behavior does not impact the score at all. Okay, and we're going to talk about a few of those, those myths that you hear out there. But the first one, and this is going to come up several times during this class because it's very important, especially when it comes to errors, and that's paying a collection account. Okay. I know that many of you that have been in mortgage for more than a hot minute have anecdotal evidence where you have seen a score drop as a result of someone paying off a collection. You've seen it. There's just no other explanation. And to be honest, it's not that I disbelieve you. I believe that you saw that happen. I believe that it happened. However, what I can tell you is there is no credit scoring algorithm in this country that is designed to punish you for paying a collection. Sure, it was irresponsible to get the collection, but is it irresponsible to pay a collection? Okay. Also, when you think about risk, it's not just that risk. There's another risk that as businesses, these companies have to worry about. That's the risk of whether or not they can continue to be a going concern. Well, credit reporting agencies make their money by companies that pay them to store the data. Collection companies, credit card companies, mortgage companies, they're paying Experian and Equifax and TransUnion to store that data for them. If credit scores were dropping as a result of people paying collections, that would be them actively disincentivizing the consumers to pay one of their best customers, collection companies. Is that a good way to stay in business? And of course it's not. There's just absolutely, it's not irresponsible behavior. It's a risk to them that they would lose good customers. There are no credit scoring algorithms designed to do it. It just doesn't make any sense. But I believe you've seen it happen, and here's why. Misinformation. Every single time that you saw a score drop and the only thing that happened was a collection account updated and now it shows paid, something else happened with that collection account. They misreported the original date of delinquency. They reported it as a revolving or installment account as opposed to a third-party collection. They changed the open date, put that in the original date of delinquency field. All of those things I just said would cause the score to drop. But it's not because the consumer paid it. It's because the collection company did something wrong after the payment was rendered. guaranteed every time because the score. Oh, go ahead.
Absolutely. I mean, James, you've told me many, many, many times how important it is that these items be placed exactly 100% accurate. I mean, the fact of the matter is, if you think about that collection scenario, if the collection agency puts the date that the collection is paid as if it were the open date of that account, all of a sudden your borrower looks to the scoring model like they have a brand new multi-$1,000 collection or whatever. And you know, guys, I mean, part of this comes down to this whole, you know, I mean, it is a giant game. You get positive points for responsible use of credit, you get negative points for irresponsible use of credit, and you have to have the balance of both to be able to have a positive credit score. And that's what most consumers don't seem to understand, is that managing credit responsibly is an important function of building a good credit score. And that turns into thousands and thousands of dollars of increased cost if they don't manage it effectively.
Yeah, absolutely. And I'm real quick, Eric, we're not quite done with risk yet, but I want to jump over and get a couple of these questions answered. David says, or asks, the biggest credit challenge of car loans, unscrupulous car dealers, all of them, will give car loans to buyers that should never get one. It screws up their credit score when the outstanding balance begins at the high credit limit. You hear the ads all the time: good credit, bad credit, no credit, we can get you a car loan. I mean, it's very much a chicken and egg question, David. I mean, those people that have bad credit or no credit and they get these car, and yeah, I'm not going to argue with you at all that they're unscrupulous loans. They have very often very high rates and fees and things like that. However, they might not have been able to get credit otherwise. And if they manage that loan properly, as bad as it is, their score will go up as a result of it. I mean, it's still good credit, good payment history is good payment history. And sometimes if that's the only loan they can get and they've got to build good, you know, the kind of the analogy I really like for explaining this is a scale. You know, so you've got your credit here, and here's all your bad credit, and here's all your good credit. And when you start off, you're like this. And then we go look at this and we see, oh, there's a lot of misinformation here. And we start, you know, oh, that medical collection that was paid off 5 years ago, they're reporting it like it was open yesterday. And, you know, that utility bill with the ex-roommates, whatever it is. And we start to take off that bad stuff. But the reality is, if they're not putting good stuff over here, does this actually move? If there's even one, you know, if there's 1 ounce over here and 0 over here, it doesn't matter if it's 50 kilograms or 1 ounce. If it's like this, and you don't put anything over here, the scale doesn't move. They have to be putting positive history here to start making it go like this. And if that unscrupulous car loan, unfortunately, is the only option they've got to start building history, I would still encourage them to do it, because you have to have credit to get credit. And I mean, it's unfortunate. And you know, that's the argument that payday lenders and pawn shops and a lot of them make all the time is, if it wasn't for us, where would these people go? And you know, right. It's very much okay. So you're taking advantage of them being stuck in a rock and a hard place, but it's also true. Where else would they go if they need those funds? So it's unfortunate, and I don't disagree with you on the terms of the loan and that that they are out there preying on those people. But the truth also exists that they do need to build credit, and they did need that car. And how else were they going to get it? And you know, especially if you're in an area that has terrible mass transit, you know.
Right. Well, and James, you know, that's a great example of you know, kind of what we see around my area a lot is you get a lot of these buy here, pay here lots that do report as if it's a revolving account, not an installment account, because they'll turn a car every couple of months if the car's broken down or is, you know, has repair issues or is a lemon, you know, that borrower is committing to a $200 or $250 a week payment on the car, and you know, they're paying for, you know, a piece of junk car. But that being said, if there's an inaccuracy here, and this gets into some of the reporting codes and stuff that you were talking about, like balance to limit ratios and some of those kind of things that I'm sure you're going to get to a little bit later. So folks, pay attention to that comment that when James gets into the difference between revolving and installment and how those factor differently in the scoring model.
Absolutely. And then just answer this other question real quick while we're doing it. That will paying off a collection raise a score if no information was misentered while reporting the payment? And actually, Eric, the answer to that is yes, it will. It's not a huge increase. It's not, you know, it's not like paying off a maxed out credit card or anything like that. But all other things being equal, if it's reported properly, you pay off a collection, your score will go up. It's not a lot, Okay, and I want to emphasize that. A lot of times the amount that the score goes up versus the amount of collection you pay off might not make it worth it if that's your reason for paying it. However, yes, if it's coded properly, a credit score will go up when a collection goes to zero. And I will say that it depends also on how many collections. If you've got 25 medical collections and you pay anywhere from $2,000 to $25 and you pay off a couple of the 25s, even if it's coded right, your score is probably not going to go up because you still have 18 other outstanding collections. But if you have one single collection and you pay that off, and that's the only collection you have, that's going to be a higher increase in your score because at that point you have zero past due balance as well. So there's several codes that get impacted. So.
Right, and that's a great point also, by the way, James. When you think about the amount of mathematical calculations, the reason they call it an algorithm is because it's a series of multi-layers, page after, I'm looking at the spreadsheet thinking this is a pretty good representation of the kind of math that goes into these scoring models. Every item of every line of every account on that report, the date open, the date closed, the current balance, the highest balance, that's 10 different factual pieces of information that count into the math on just one account. Multiply that by maybe a couple hundred accounts over 10, 12, 15 years, and you begin to see how it's, this goes back to one of the other myths that you often talk about, which is, well, how much does paying off a collection going to increase my score? Well, how many different variables are there to figuring that out? It's near impossible to calculate exactly how much one specific action would do to improve the score, right?
Absolutely. In fact, if anybody, you'll never hear me say, "Oh yes, it's going to improve your score X number of points." I'll give you examples and I'll give you estimates and I'll say to the best of my knowledge about this much. And the reason I'm non-committal is because if anybody is absolutely committing and saying for certain this is going to happen, it's impossible. There's no way. The best they're giving you is an educated guess, no matter what. It's just there's nobody that can say that because there's so many other factors going on. If you say that, but at the same, you say, oh yeah, it's going to be this number of points, but at the same time, your average age of accounts rolls from 9 years and 11 months to 10 years. It might be 4 times the amount of points I said. Likewise, you open a new account, averaging that 0, you had 6 years of average length of credit history on your trade lines, and now you have 4.5. So you're not past that 5-year threshold, and that's just talking about ages. So when Eric's talking about all the different factors, there's balance, there's age, there's number of accounts, there's mixture of accounts, and it's just there's so many factors that are being mathematically measured at once that there is no, I'd like to say Mr. Stephen Hawking could perhaps do that if he'd read it a couple times in his head, but I don't even think he could. So, all right, we'll jump back, finish up risk just a little bit more. A couple more examples I always like to talk about, just because they come up so frequently. Personal information impacting the score. I hear women that have been married more than once say, "Well, isn't it going to make me look like more of a risk that I have a few last names?" Or isn't it going to make me look like more of a risk that I have multiple addresses? The simple answer to all of that is absolutely not. Your personal information is never factored into the score. And a couple of others I like to talk, just so you understand kind of the concepts that go behind it. For the addresses, if having too many addresses negatively impacted the score, who would be most negatively impacted by that? Put it this way. I served in the Navy, and that would not have been good for the multiple duty stations. The military would be most negatively affected by having multiple addresses negatively impact the score. Not to mention, if you've ever worked at like a restaurant or a retail establishment that was just opened, and they brought in a manager that was like their best manager to open it, and he or she was there for 6 or 8 months, and then trained their replacement and moved on to open the next store. A lot of these places, their most responsible ringers are the ones that have the most addresses and move around the most. There's just never been any positive correlation, or especially causation found between a lower credit score and multiple addresses. But even if it was, including personal information is an absolute minefield for legality purposes. I heard this smart guy who claims to be a credit expert was writing in the, I'm drawing a blank now if it was Wall Street Journal or Fox.com, but in any case, it was online, and said that if you live in a desirable zip code, your score will automatically go up 150 points, and if you live in an undesirable zip code, it will drop 40 points. And I'm like, first of all, who decides desirability, and does that not have ECOA violation written all over it? And, you know, it's just absolutely not.
Yeah, that would be flagrant redlining from a Fair Housing Act violation.
Absolutely.
Yeah, that would be catastrophic for a multi-billion-dollar company like a credit reporting agency.
Yeah, that's exactly right. And it's just, you know, but it preys on people's fears, and it's sensationalist, and so it gets lots of clicks on the article, whether it's correct or not, but then you have people that think it's correct, unfortunately. And the last one I like to talk about for risk, just again, is it's kind of, I think it's a good example of why people misunderstand it and also how it works, is there is something called opt-in, opt-out, which is the program where you can choose not to get those pre-approved offers for credit cards and things like that in the mail. When the Fair and Accurate Credit Transactions Act, FACTA, passed back in 2003, this was part of that law. There's an online site, Google opt-in, opt-out.org, or just opt-in, opt-out, and it'll be the first organic site. It's administered by the government. I think it's actually .org. But here's the thing. The next 20 sites below that are experts telling you that if you do opt out, your score will automatically increase as much as 25 to 40 points. No, really, really no. Not just because there's no risk involved. Are you more or less of a risk because you choose not to get offers in the mail? And there's no correlation or causation there. But beyond that, remember I mentioned that the other side of the risk is these are businesses and it's a risk to their business. Well, another way that credit reporting agencies make money is by selling lists with your name and your address and your phone number on it to creditors so they can advertise to you and pre-approve you and things like that. So when you opt out, you reduce their capacity to make income. Is there a universe that exists where you would be rewarded for that? And of course not. It's just, again, aside from not being predictive, it would impact their bottom line negatively. There's no way your score would go up as a result of that. And again, you know, I kind of, not to get into too much of minutia, but I'd like to kind of explain where it came from. When they do that, when they advertise to you, it's an inquiry. And we'll talk about inquiries a little bit later, but suffice it to say, this is a soft inquiry, which will never impact your score. But someone who thought they were an expert went to Fair Isaac website. They saw that a single inquiry could, at a maximum, impact you 25 or 40 points in under really rare, bad situations, you know, if you're in a certain circumstance. And so that person said, well, if an inquiry could cost this many points, then by opting out and not getting inquiries, you'll get this many points. And obviously, that's not at all the way it works. You know, there's that meme that says, that's not how this works. That's not how any of this works. Well, that would be appropriate in that situation. It's just not how it works, okay, folks? All right, so that is risk. Just to reiterate the most important part of it there, responsible behavior makes your score go up. Irresponsible behavior makes your score go down. You do need credit on there to establish a score, and information that's not predictive, neutral information is not there anyway. It's not in the algorithm, okay? So that's risk. The gray area. This one is this is my concept that the way I talk about it. I'm gonna try and get through it a little bit quicker because it can bog us down to get to the rest of the information. But I break it up into three parts. We've already covered it a little bit. At the individual level, you know, we've talked about math, we've talked about algorithms, we've talked about data. It seems like things that should be black and white and just very clear cut and, you know, delineated purposes for each of these things. And it just doesn't end up working that way, either by human error or by, you know, ghost, you know, La Machina, ghost in the machine kind of stuff where the software doesn't work the way it's supposed to. Whatever the case, there is gray area that exists here at three different levels. The first one is at the individual level. And the easiest way to explain this is we've already talked about the algorithm and all these different codes. Well, you've probably all been told things like don't have more than 10 accounts with balances, don't have more than 5 consumer finance accounts, keep all of your balance limit ratios below 50%, as though there are rules, you know, hard and fast rules across the board. None of those are true for everybody. It's just not the way it works. You know, one of you that's sitting in the crowd right now might have 20 years of good positive credit history and paid off 3 mortgages and, you know, have $200,000 of available credit on your credit cards and only using $200 of it. And you want to open up 20 accounts at the department stores and have a little balance on all of them? That's not going to really impact your score much at all. You've proven yourself trustworthy. Whereas, you know, there might be other people that just started establishing their credit history and only have 2 First Premier cards with a $500 limit on each, and by having both of those accounts with a balance, they're losing points because they can't be trusted with 2 accounts with a balance. You know, it just depends on where you're at in your life at that time, what's on your credit report, how those things are going to work. Some people might be able to have 75% balance limit ratio on their credit cards and really not lose any points. There's other people in the audience that they might really get hit hard at 20% balance limit ratio. You know, that might cost them 15 points where it pushes them from a 685 to a 670, and now they can't go conventional. I mean, you know, it's something that small. So it's just, it varies per individual and per your history, okay? So that's gray area, because there is no black and white answer you can give to a borrower that's going to be right all the time. Their circumstances could change today. They get 3 new medical collections, and what you told them is now wrong. And so that's why we have to be non-committal and give this advice as though, hey, under these circumstances, this is the way it could happen, you know. The next part of the gray area happens at a global level, and this one is one that I know that a lot of people find frustrating, but it makes sense that, you know, it's basically an acceptance that change exists. You've got all these different credit scoring models, right? You've got Vantage and FICO, and within each of those, FICO has 23 different models from Gen 5 to Gen 9 that they still sell that can all be changed for insurance or car or mortgage, or, you know, so you've got all these literally hundreds, if not thousands, of scoring models that are different for bank and everything else, but they have something in common. They realize that our behavior collectively as a society changes at times. Our savings rates change, our spending rates. You know, we're a consumer spending-driven economy, and we behave very differently during crisis, and then sometimes those crises are deep enough and create enough of an issue that it changes the way that we behave from that point moving forward. Okay, this Great Recession really changed the way that we use finance, the way we even look at mortgages and purchasing houses and things like that. Drove a lot of more investors into the market that bought up a lot of houses. There's a lot more renters now. It's just, and we're still adjusting to that. But all of those scores recognize that. And how do they measure it? What do they do? How do they say, well, you know, people are changing, but how are we going to figure this out? They look at a sample set. You know, at Experian, for our plus score, we used to look at 10,000 people, and this is virtually every day. We would take a scenario and say, okay, let's look at people that were 30 days late on their automobiles 6 months ago and see where are they now? Where is their score? And did they go more delinquent? Did they get caught up? Did they go delinquent on something else? Was this a leading indicator? Should we have seen this as an indicator that they were going to go delinquent on their mortgage? You know, back in 2009, early in 2009, all of a sudden, like the default rate between people that had let their car go, you know, start to go delinquent 6 months ago, and then the number of people that were delinquent on their house all of a sudden was like, went from like 3 or 4% to like 17%. And it's like, wow, our algorithms are all wrong. And so we go in and we turn that way up so that late payment, all of a sudden, instead of being, you know, 40 points, now it's 100 points, because that's such a leading indicator of future risk. And they're doing that every day. So, I mean, in a real-world scenario, you have a borrower who was 30 days late on her car 2 months ago, and now she's applying. She's got a letter of explanation. Her score is fine. It's the only late payment she's ever had in her life. And you know what? You're actually going to be able to get this loan done. We found out, you know, you're working out. And then we go in and we change that score. And you go to closing, and you're expecting her to be, you know, 65 or whatever, because we amped up the predictive nature of that late payment. She drops to a 630. Like, nothing changed. It's the exact same report. She hasn't done anything else wrong. In fact, now she's got another month of history, but it doesn't matter, because we saw that as so much more predictive. So her score dropped not because of anything she did, but because of something everyone else did. Now, if that's not gray area, I don't know what is. So that's, you know,
yeah, definitely.
I know that. Yeah, go ahead.
Well, and think about how many different models of scores there are. I mean, how many credit scores does any one borrower have? Well, it depends on the number of lines of credit that are available to them and all the different variable models that can be applied. I mean, there's what, 7 or 8 different scoring models for bankruptcy alone. I mean, anybody who's ever had a bankruptcy will, and the systems randomly or automatically select that based on some of the factual data in that bureau or in that borrower's report. So, I mean, you guys, one of the big lessons here is one, is there any effective way of predicting how much exact impact it's going to be? I mean, it kind of becomes kind of like the actuarial studies that insurance companies do. Like, how do they determine car insurance rates? Like, the 18-year-old male driving his first car. I mean, it's like there's like a 99.999% chance he's going to have some sort of wreck before he reaches the age of 25. So statistically, because of the higher probability of poor performance, they raise the negative impact of a particular irresponsible behavior for that specific model and for that specific. The other thing, and this is changing a little bit, but James, you and I've talked about this many, many times, is that up to just recently, credit scores were pretty much a snapshot, right? I mean, it'd be like trying to take a picture of a 5-lane highway in Los Angeles during rush hour, and you snap the picture once, and then 10 seconds or 30 seconds later you snap another picture. There's a whole different set of cars on the road, right?
Well,
and because these things are constantly in movement.
I was going to say, it's kind of a snapshot of a snapshot, because when you think about it, when the credit card companies report, they do so one time per month on the statement date. They take that snapshot and report it to credit reporting agencies, and then the credit reporting agencies take their snapshot of whatever they have at that moment, whether they've been updated by the credit card companies or not. So it's a snapshot of a snapshot, really.
Yeah, definitely. Of course, that's changing a little bit now with some of the trended data stuff. But when will that play in? I mean, it's not. I know we're a little out of sequence on the program here, but how much impact is that going to have, and when do you think that'll start to begin to actually start to really truly affect the actual root scores, as opposed to just being considered in the automated underwriting engines?
Well, I'm not sure if you actually meant to do this or not, but I think that at least subconsciously you did. That's the perfect lead into my third part of gray area, because the third part of gray area.
Beautiful.
Yeah, it is.
That was not a setup, guys.
So the third part of the gray area that Eric just perfectly alluded to is that I promise you that everything we're telling you today, all of our information right now, is as accurate as it can possibly be. I stay on as many mailing lists and email lists and congressional mailing lists as I possibly can to make sure that I'm giving you the most up-to-date information with regard to state, federal, local laws, changes within the Consumer Data Industry Association, which is the trade group, all of that stuff. However, does that mean what I tell you today will still be correct tomorrow? And this is the most frustrating point for me, because of course the answer is no. It doesn't. This stuff changes a lot. There's case law. There's all kinds of things that happen that can change the way that these are implied. And Eric just talked about probably the largest change in the utilization of credit data in 50 years, since the inception of the Fair Credit Reporting Act. And it's called trended data. And as of, well, let me first tell, hopefully you're all on my other webinars, and and you know what that is when I say trended data, but just in case, now for mortgage only in your underwriting engine, and this, I believe it's fully implemented now for Fannie. The implementation through Freddie, through LP, should be coming out here in the next 6 months. Who knows with Ginnie, they'll catch up eventually. But right now in those underwriting engines for desktop DU10, you are using trended data on revolving accounts only for the last 2 years only. And what it is they're looking at what was the limit, what was the balance, what was the amount that they were supposed to pay, what was the amount they did pay, okay? And if they have a high balance limit ratio and they're not paying much on it, or they're just paying the minimum balance, that is creating a much more difficult lending situation for you than it has in the past. As Eric said, in the past you could have paid all your credit cards down to a really low balance, waited for them to report to the credit reporting agencies, had your score pulled, had what is technically an artificial score, because you borrowed it from mom and dad, and then you're going to pay them right back off the credit card by writing a check or whatever it is. But you could do that and manipulate your score to make it look very high by just not owing that debt at the moment that the picture was taken. This is accounting for that. And it's also helping those people that actually do have lots of money and pay their credit cards off every single month, but it happens to report on a day that's inconvenient for them to pay it, so it looks like they're maxed out all the time when really they're paying off their credit card. Those people wouldn't be a problem to lend to anymore with, through Desktop Underwriter, because now that's showing, well, yeah, we see the score, but this is offsetting for that. So there's some people it helps, some people it hurts, but the bottom line for me is I actually like it. I think that it is a very, very predictive set of information points. When you think about it, who are the people that are not managing their money properly and that are potentially the biggest threat if everything goes south? And it's those that have really high credit card balances that are kind of living beyond their means. I mean, you see those dominoes fall like that. Stops paying credit cards, stops paying cars, stops paying house. I mean, it's shown itself over and over again that is a huge leading indicator. So I'm not opposed to trended data. I mean, obviously for anything like this, my biggest concern is the data accurate? Are they looking at it the right way? And are they rolling it out in a way that consumers are going to understand it and the people using the data are going to understand it? So far they've been going fairly slow with this rollout. They had a faster timetable that they started off with, and they have backed off of that and rolled it out more slowly. The other part of Eric's question, when are credit scores going to be impacted? Because right now, they are not. This trended data is only impacting the underwriting engines. It's not impacting the scoring algorithms yet. Now, with that said, the current versions of the scores from the two biggest providers, Fair Isaac FICO score and Vantage scores, are Vantage is 3.2, but 3.0, and FICO is 9.4, but again, 9, FICO 9 and and Vantage 3. They have not confirmed this. This is my personal opinion based on what I understand from the inside. Because they claim to provide the best predictors, the most accurate data. They want to be the best resource for telling you whether or not what we talked about with risk is going to happen. And if this trended data is so good and so predictive, I think they'd be fools to not include it. So my gut tells me that when Vantage 4 and FICO 10 roll out, they are going to, at least as an option, include trended data in there. I can't see a scenario where they could continue to claim to be the experts in scoring and risk that they are without having it at least as an option in those scores. So right now that's not the case, but my gut tells me it's coming.
Okay, so guys, we're about 45 minutes in at the moment, and there's been multiple questions come through about how we can get more in-depth information. Obviously, James is just starting to scratch the surface at this point as to what this goes deeper into. And there's one quick thing I wanted to introduce everybody to just really, really quickly here right before the top of the hour. James, if you can go to the slide about the BCE course. I think we're about 4 slides down. Just so you guys know, we put together a special program. Yeah, one more slide, I think. We are doing a program, and this will be the second time we've done this program as a live webinar. We've had it available in video, but as a result of some of the recent changes with trended data and all those kind of things, one of the things that we're going to be doing is providing you a 5-part, 90-minute per session, 5 sessions at 90 minutes, what we call a web shop. It's a very in-depth training where you guys are going to be able to really roll up your sleeves and get your hands dirty with all of the minute intricacies and variances that really truly have an impact on the scoring models and really helping you become a true expert in credit and a true educator to your community. There's 2 elements to this, guys. One is understanding how to help your customers when they come in for a loan and they've got a couple of hoops to jump through to get their score up to a 640 or a 660 or a 680 so they can get a better deal, a lower rate or fewer risk-based price hits. The second part of that is, what do you do with that knowledge, and how can that empower you to be an advocate and a person of influence in the community that would help you attract more opportunities to do more loans? I mean, to be able to go out and do lunch and learns for real estate groups, or speak at a church or a trade association or a community group or charity, and offer real solid factual data education on how to better manage credit, how to better improve the financial life of the consumer, and how that plays into the cost of credit and the expense of, and how it impacts things way even beyond lending, insurance and all those other things that are rated up because of somebody with a, somebody with a 620 FICO is going to pay a lot more for car insurance than somebody with a 720, and even that, how many thousands of dollars per year, or how many thousands of dollars over 10 or 15 or 20 years is that going to cost that family if they don't learn how to better manage their credit. So it's really from an advocacy and a consumer benefit driven initiative, but there's also an ancillary benefit there of being the education source and expert in your community. Gives you huge potential to help a lot more people on a much larger scale. So we're going to be putting you through this Becoming a Credit Educator course. You have the availability. It starts October 10th at 3:30 in the afternoon Central. We'll go 3:30 to 5 for the next 5 Mondays in October, starting October 10th. How to get access to it, guys? If you go to if you just go to maximumcoach.com/credit, maximumcoach.com/credit, that will give you access to that information. When you apply, or when you select it in your shopping cart. James, can you go to the next slide, please? So the long story short, guys, if you go to the maximumcoach.com/credit website, you go ahead and select that, put it into the shopping cart, and then apply hit the apply button. When you punch in the credit code, the all capital letters, the code credit, will knock it down to $297. We're going to give you a ton of tools and resources that will help you with this, FICO 6 credit code scoring requirements, what's wrong with this report system, and you'll see the agenda on the maximumcoach.com/credit page. You can see all the content that'll be covered in that 5-part web shop on that website. Guys, keep in mind that there's a great question in here from Jeff Coast about how do you reflect someone who's got a 0% balance, promotional offer from Best Buy or whatever, no money down, 12 months, same as cash type of financing incentives. The problem is keep in mind, guys, that credit scoring is about credit responsibility, not necessarily financial responsibility. So you got to keep that in mind when you're looking at these nuances and when you're talking about this kind of information. Like, for example, one of the things that I used to be confused about that James kind of corrected me on is I always used to think installment loans were better than revolving loans because, installment loans demonstrate financial responsibility. Before you take on a $200 a month installment payment, you got to look at your budget. You got to think ahead a little bit further. And, when you take that out for 12 months, you pay on it for 12 months, you're done, it's over, you move on. You don't just keep carrying the minimum payment and end up paying on that $2,000 purchase for 30 years kind of thing. But from the scoring models, the installment loan doesn't benefit you as much as the revolving loan because the revolving loan has length. It has greater history because you can run up that balance and pay it off and run it up and pay it off and run it up and pay it off. There's more potential to misuse credit with a revolving account as well. So responsible use of revolving accounts actually build score faster, which is something that James taught me. So keep in mind, guys, that building a positive credit score is not necessarily building a positive financial future. Like one of the other case examples of that, James, you and I've talked about what to do with the, what is, the folks that are following sort of the Financial Peace University Dave Ramsey system. They got in trouble 10 years ago with credit. They've been a ghost to the system from then on, but maybe they've had 1 or 2 small medical collections pop up here or there, right? They have no
Right.
established positive credit to offset the negative credit from the past, and so their scores are unfairly low.
Absolutely.
Where I think all of us would pretty much agree that, being responsible, sticking to a budget, don't buy what you don't have money for, and save for, larger purchases is a more fiscally responsible way of managing your money. But that doesn't equate to how the scoring models treat it, right?
Yeah, well, and that's the Financial Peace University in particular is one that, I understand certainly where Mr. Ramsey is coming from on that. I understand the appeal of being debt-free, but being debt-free does not necessarily mean you have to be credit-free, because being without any credit or any credit scores is a major detriment. It's not only an emergency, but there are so many non-borrowing experiences that everyday people go through where they look at your credit score. Renting an apartment, when you go for insurance, and I'll give you a real world example for any property and casualty insurance. Now, if you're in Hawaii, California, or Maryland, this doesn't apply to you. Those are the only 3 states where it's illegal. But if you're in any of the other 47 states, for example, here in Texas, in a suburb of Dallas, Plano, we had a farmer's insurance agent run a quote for us. $150,000 house. No, it was not an outhouse for all of you in California. It was a real house. You can't actually get a house for $150,000 outside of Dallas, Texas. But in any case, had them run an insurance quote on the house. One at a 580 credit score, one at a 720 credit score. Everything else was the same. Same coverage, same house, same income, same everything. The person with the 720, it came in an $895 annual policy. Okay? That person with the 580, everything else being equal, $3,750 for the exact same policy, and that would be comparable. A 580 and a no score are virtually the same. So, that's just a real-world example of where the Financial Peace University, where you take on no debt and have no credit score, it just does not work in the real world. You just can't do it that way. You do have to have credit and credit history in order to not be penalized in a lot of different situations.
Absolutely. Guys, this goes back into, James, and I don't know how much time you've got where you could stick around and
a little bit for questions.
Continue to give information and questions. I know there were some other deeper things that we wanted to try and get into today that we kind of ran out of time, or we're running a little short on time for. Maybe you can go back into a couple of the little nuanced things, some of my favorite ones like ODD versus DLA and some of those kind of concepts.
Right. Well, that's exactly what I was, kind of whet appetite for more training from me. I think maybe we'll talk about ODD and then maybe inquiries real quick. And I think those send it, and we'll answer any other questions. You guys make sure, like I said, we love questions. And I'll stick around for as many questions we get those answered as well. And we'll talk about these 2 concepts here while hopefully Eric has a chance to grab a pre-flight beverage there.
I got a lot of work ahead of me before that. Happy hour won't happen until about 7 o'clock tonight, but
yeah.
But anyway, all right, guys.
So real quick, George said, guys, if this is included or something like it with CMPS. Correct me if I'm wrong, Eric, but I believe not this past year, but FCRA was part of the 2015 curriculum. But it's not, it's a very small component of the ongoing training, the annual training. Is that correct?
Yeah, and actually, to be honest, James, what they're talking about is the Certified Mortgage Planning Specialist training, CMPS, offered by, the founder of the company is Jabron Nicholas. It's not a bad suggestion to include it, but to my knowledge, no, it is not part of their base curriculum, as I understand it. Although it's a really good suggestion and wouldn't be a bad introduction for me to make for you, James, as well, to introduce you to Jabron at some point in the not too distant future here. That being said, just so you know, James, I'm not seeing what is or isn't on the screen at the moment. My internet connection got a little disrupted here, so.
Okay, that's good. I lost your video feed too, so mine's still.
Yeah, you did, and I'm working to get it back, but I'm behind the scenes here.
Yeah, no,
anyway, so if you want to go ahead and run through some of the things that that we had on the other couple of slides that you had in there and hit some of the high points of that. That'd be great.
Yeah, absolutely. Okay, so yeah, let's. I always like to at least get these two. They're two of my favorites, and they're two of the, I think, the most common things that people believe, and there's anecdotal evidence that kind of go against what the truth is. And we kind of talked about this with the collections that you know, they don't lower score, but kind of the root cause of that is a date called ODD. And it could be original delinquency date or original date of delinquency. Saying it either way is correct through CDIA guidelines. But it is a very, very important date. It exists on every potentially negative item, whether it's a 30-day late payment or a charged-off foreclosure. They all have an ODD, and it's defined very clearly as the first missed payment that leads to the most negative status without becoming current again. Okay, the first late payment that leads to the most negative status without becoming current again. So if you ever bring it current, so if you have a credit card and it goes 30, 60, 90, current, 30, 60, 90, current, each of those 30, 60, 90s have their own original, because it's that 30 that led to the 90 without becoming current again. So that string of delinquency would stay on file if everything was reported accurately and legally. That 30, 60, 90, that 30 months of delinquency would drop off 7 years from when the 30-day happened. So not the 60 or the 90, the 30. Likewise, if it went 30, 60, 90, 120, 150, 180, charge-off, however long, that entire trade line should be deleted 7 years from that 30-day late payment. That's the way the law works. Now, here's the real kicker. It is a sticky date. The federal law says that, you know, well, there's a lot of things, but it says if you choose to report, that information you report must be 100% accurate, complete, and verifiable. Part of that for this would be, it says that potentially negative information can only be on file for a maximum of 7 years. Well, it's not just the trade line that's potentially negative. It's the past due balance, regardless of who owns it, okay? So once they went 30 days late, that was a past due balance. And then they never got current, so that past due balance has been on file for 7 years. So it doesn't matter if it's been sold to 4 different collection companies. That past due balance has to be deleted from the credit report 7 years from the date that first 30-day late payment. You can't re-age it by selling it to another collection company. Now, I bet a lot of people in the audience probably think that every time they sell it, they get another 7 years. So that collection company gets 7 years. And that's absolutely false through federal law. The reason you think it is that this portion of federal law is followed so infrequently, and there's so much anecdotal evidence that really what it is, it's evidence of them breaking the law. But it happens so frequently that people are like, well, how could it possibly be illegal when it happens with such frequency? Well, it is, regardless of how often they do it, it's still illegal. But it just happens a lot. But nonetheless, ODD, it's extremely important. Now, the downside about it, aside from what we've already talked about, you don't ever see it on a mortgage report or very, very infrequently, because it's not the same as date of last activity. You'll always see it on the consumer reports, though. The reports that come directly from Experian, Equifax, and TransUnion, you'll see it in reverse. On Experian, on the far right-hand column, will say this account is scheduled to remain on file until XYZ date. We'll go back 7 years from that date, and that's the original date of delinquency. It's telling the consumer, based on the ODD, when it's supposed to be deleted. Real quick, about date of last activity, it's still important, but not for necessarily the reason that you think. The reason that date of last activity shows up on your mortgage reports is it tells you whether or not the consumer owes the debt. So there's two different dates on any account. There's a date where they wouldn't legally owe them. We're not a debtor country. We don't throw people in debtor prison. You know, just like there's a statute of limitation on speeding or jaywalking or burglary. There's a statute of limitations on debt where after this date, the consumer doesn't legally owe it anymore. And I'm just going to use Texas again. There's, you know, a lot of states have gone to this 4 years for open account, 5 year for installment account standard. There's a little other differences. It's 2.5 years for a UCC or a verbal contract in California. It's 3 years in Connecticut. So everybody's a little different, but 4 and 5 is pretty much standard. And basically what that means for an open account, that's credit cards, that's medical, that's utilities, anything that you didn't sign, like, you know, with anything that wasn't collateralized for X amount of time. For their open account, 4 years from the date of last activity, not the original date of delinquency. Those are two different things. Remember, it's got to be current to change it. So if you go 30, 60 and make one payment, are you current? No, you're still one payment behind. That would be 30, 60, 30. You know, and you see people do that sometimes, 30, 30, 60, 30, 30, 60, 90, 60. And they're still delinquent. That didn't, they made a payment, but it's activity. So it would change the date of last activity, but not the original date of delinquency in those scenarios, okay? So that date of last activity, once that happens, there hasn't been any activity on this account, no payment, nothing else, and 4 years goes by, they don't legally owe it anymore. It's past the statute of limitations. It's no longer their debt. That's why, in fact, at that point, if the creditor were to sue them, they could countersue and claim what's called an affirmative defense of statute limitations. And so they would actually win against the creditor. And that's also why you see these kind of psychology studies going on in the collection industry. They'll say, hey, you know what? You're a good person. I'm a good person. Why don't you just make a $10 good faith payment to show your willingness to satisfy this debt that you know is yours? And, people go, oh, all right. And they write a $10, or give an authorization for a $10 payment on a 25-year-old account. Well, they just started a new statute of limitations. They just re-aged it. You can't do that on original date of delinquency. Once that's set, it's set in stone. But the date of last activity changes whenever there's activity. So that's why you have them do that and have them make this token payment, because they're actually re-aging the debt at that point. So, again, there's a big difference between the two. Date of last activity also primarily relies on state law, whereas ODD is Federal Fair Credit Reporting Act all the way, okay? Let's see. Last thing that we're going to talk about, and then any questions. So, yeah. If anybody's going to make sure and fire those questions out, because I will stick around to answer them if y'all want. I don't know if I have a slide with inquiries on it here. We kind of changed up what we were doing here, Eric. So I'll go to here and I'll talk about inquiries real quick, just because there's a couple really common misconceptions with inquiries that I like to clear up. We already kind of talked about soft and hard. Soft inquiries are anything where you're basically not applying for an extension of credit. The three most common are when somebody wants to do business with you. So that's a promotional inquiry. That's the one you get in the mail. When you check your own credit, you go online, you go to Privacy Guard or whatever, that's a soft inquiry. Also, if you already have a relationship with a creditor and they're checking on you, like you look at your consumer report, you see that you have an American Express account, and American Express has checked your credit every single month for the last 2 years. Those are soft inquiries. They're not impacting you. Those are called AR, account review inquiries, okay? So those are the most common soft. Now, like everything else here, there's some gray area. In the middle, you've got like apartment screeners, employment screeners, insurance companies, utility companies. All of those industries utilize your credit. I'm going to tell you, in particular, the employment screeners, they could pull a hard inquiry, but I've never seen them do so. It's always been soft. That used to be true with apartment screeners, but now it seems like I'm seeing more and more they pull a hard inquiry. Insurance, for your higher-end insurance company, your Geico, your Progressive, State Farm, Farmers, Allstate, their USAA, they're pulling a soft inquiry. Some of the more kind of the General or Fred Loya or Rodney DeYoung, kind of the second or third chance insurance companies, they might pull a hard inquiry on you, okay? And then finally, utility companies, total crapshoot. Like even within a single company, like Verizon Wireless and AT&T Wireless, if you go into the AT&T or Verizon store, they tend to pull a soft inquiry. If you go to their kiosk at Sam's or Costco or something, they tend to pull a hard inquiry. T-Mobile is almost always a hard inquiry. Boost Mobile doesn't even check your credit because they're not doing something, you're having to prepay. Same thing with UVerse versus Fios. It's just, and that's important because as we're going to see in a second, a single inquiry under certain circumstances can be more of a detriment than you would think to your credit score, okay? And so, if they were right on the cusp at a 681 and you're going conventional and they want to go ahead and go turn on the cable before they close, maybe tap the brakes. Let's get this closed first because we don't want any surprises at closing. So to explain how a single inquiry can hurt you maybe a little bit more than you thought in the past, I use a hypothetical. These are two actual people. This is a scenario that happened, but it's I don't give you their names, essentially, what comes out. But the kid and the experienced guy. Kid, they both have a 720 credit score, by the way. Okay, so I just want to get that Make sure that's established. You have the exact same score, okay? And they're going to do the exact same thing, but it's going to affect them radically different. Kid has only 3 trade lines, 2 credit cards and an automobile. They are all just over 4 years old, not quite 5. So he's almost done paying off the car. His credit cards have been extended. He's got $10,000 of limit. He's only using $50 of it right now. Okay, so he's using almost none of his available $10,000. Almost paid off the car. He hasn't applied for any other credit in the last 2 years. Inquiries do stay on file for 2 years. They affect you most heavily for the first 90 to 180 days, but they stay on file for 2 years. But nonetheless, he hasn't applied for anything in the last 2 years. So 720 credit score, that is about as perfect of a credit history as you can start off with. Good mix. You got revolving, you got installment, no missed payments, good utilization. You know, that's great. 720 is a threshold where you go from having good credit to great credit. He's a 720. He deserves it. It's a great way to start. This guy's also a 720. Very different reasons, though. He's got 30 years of positive credit history, 22 on his current mortgage, paid off second mortgage, paid off cars, $100,000 of available credit, active card. I mean, he also has not applied for anything in the last 2 years. But right now, his balance limit ratio is very high. He's using $97,000 out of that $100,000. So very high balance limit ratio, okay? And today, they both apply for something. Doesn't matter what it is. In this case, it was a mortgage, but it could have been a mortgage or a credit card or whatever. They had one inquiry show up on their credit report. That's where they saw the 720. And the next day, they shopped at another place. They both went and applied for a mortgage somewhere else. So that person, although we'll get into this for just a second afterwards, that second inquiry for a mortgage isn't going to impact the score negatively because they already applied for a mortgage. But that person, that second application taker, is going to see the impact of that first inquiry. Okay. Well, I can't really ask you. I usually, who do you think was impacted more? But I can't see you to raise your hand. So I'm going to tell you. Most people think, oh, yeah, well, the guy with all the history, obviously, he wasn't nearly as impacted as the kid. So that kid wasn't impacted. And in fact, in this case, he still had a 720. That inquiry had a net impact of 0. Where's the risk, you know? I mean, if he was all the studies that we talked about where they look, every day at changing the algorithm, they all say the same thing. If people are in trouble, they'll use the credit available to them to get themselves out of trouble before they start applying for new stuff. Now, there might be that one person here or there that says, oh, I'm about to lose my job, better apply for some credit cards just in case. But that's the anomaly, not the rule, okay? So this guy that has no balances virtually on his $10,000 credit card and he applies for something, I mean, you can make an argument he needs more credit. He needs more history. He needs more trade lines to build for his future. So 0 impact. 720, still a 720, no change in risk. However, this guy with the high balance limit ratio, 97% out, 97,000, that one inquiry, 35 points, dropped him from a 720 to a 685. It's like, wow, that's huge. Why? 3 big reasons. With that kind of utilization, there's 2 things we've got to worry about from a money perspective. Credit reports show credit. They don't show finances. They don't show salaries. They don't show tips or wages or commissions or holdings or anything like that. So that first thing I got to worry about is a lot of people with that $97,000 of revolving debt, they can't afford the credit they've already taken out. They've gotten underwater, and they're applying to move stuff around, do a 0% transfer, all that kind of stuff. That's a risk. Number 2, maybe he doesn't make quite as much as he says. Maybe he's living off those credits. Maybe he's actually lost his job. We had to take that into consideration from a risk perspective. But third, and most importantly, okay, and this is why inquiries impact more during that first 90 to 100 days. An inquiry is a record of you applying for credit. It does not indicate whether or not you got approved. That guy had a 720 credit score. He's had good credit for 30 years. He's never missed a payment. Whatever he applied for yesterday, he got approved for it. And we don't know what it was. So from a risk perspective, that inquiry has to be a placeholder for the worst case scenario for whatever he got approved for yesterday. Maybe that was a $600,000 HELOC and he took out all the cash he put it to Tijuana. I need a placeholder to show the potential risk of what could happen with that trade line because of how high his balance limit ratio is. Okay? So that's why a single inquiry can impact you so much, because it has to be a placeholder for a worst case scenario for risk. Okay? And we got a couple questions here. Eric Eric asked questions. Eric. Okay, doctor. Anyway. So Eric's first question: I've been told multiple mortgage inquiries within 30 days only count as a single inquiry. Is this true? Yes. Plus, I use this, and it's a great Eric. It's almost like this is not Eric. I know it's getting confusing, but Eric.
The different Eric.
Yeah, it's a different Eric. It's like I asked you to lead into it because it's perfect. The other part about inquiries I'd like to talk about and use this as an explanation how I think a lot of misinformation gets out there. It's because of those changes we talked about in the gray area. I don't think most people are out there trying to purposely inject misinformation or wrong information into the system. I think it happens naturally because of expirations and because just time passes and things go wrong. So prior to 2004, it would have been completely accurate to say that for mortgages and only mortgages, any increase within 15 days will only count as one. That was before 2004. It changed. In 2004, add autos, okay? So now this applies to not only mortgages, but also auto loans. And any increase for the same permissible purpose in those two industries within a 30-day window only count as one. Now, it changed again in 2013. But real quick with these two, there's two big sales points that come into play here. Number one, that consumer that comes in and says, "Oh yeah, well I've got great credit. They shotgun my application out to 50 different auto dealerships and it dropped my score 30 points." No, it didn't. They all only count as one. Yeah, they're all listed, but they only count as one for scoring purposes. That first inquiry drops you that much. All those others are being standardized down to one. And for the mortgage side of it, that consumer says, "Oh, I've already had my bank pull it." This is for your real estate people. "I've already had my bank pull it, so I don't want the hit on my credit." Well, if it was in the last, we'll get to that in a second. If it was very recent, you won't be hit by it. In fact, you're being a smart consumer to go ahead and shop my rate, see if I can beat the bank that you've already pulled from, see if I can beat their rates or their service or whatever else it is, and you're not going to be negatively impacted by that. Okay. Now, I certainly bag on the credit reporting agencies and credit scoring places when they do something wrong. I'm about to give you an example of where they did something right. In 2013, Fair Isaac said, this process takes a lot longer. Consumers have a lot more resources to look for the best rate. The way that we're doing it's not working. We need to give them more time to shop if they are truly shopping. So here's what they did. First of all, they added student loans. So now you can shop for student loans the same way you can for autos or mortgages and not be penalized. Secondly, in addition to that 30-day window, once the 30 days expires, they're going to go back and look, are they still shopping, within the last 15 days of that expiration? So there's the first 15 days and the second 15 days. If in that last 15 days, if you actually did shop, again, then from that date, they're going to open another 15-day window. And if you shop within that 15-day window, they're going to open another 15-day window. And if you shop within that window, they're going to open another 15-day window. All the way out for infinity if you're still shopping for that same permissible purpose. And all of those inquiries going out, as long as you're actually shopping, are only going to count for one inquiry in each of those three industries, okay? So it's not just 30 days anymore. It's 30 days with a 15-day rolling window at the end to reward those individuals, or to not penalize those individuals that are still actively shopping for the best possible rate, okay? So that's how it actually works. Eric, you had another follow-up question. If so, does the impact of the initial inquiry show up on the second report that they pull at the second? Yes, it does, Eric, absolutely. That's what I say. So the question is essentially, so at first when they pull, they get a score, but now they have an inquiry on file. Then the second lender pulls it. Yes, they are going to see the impact of that first inquiry. Now the third lender will only see the impact of the first lender, and the fourth lender will only see the impact of the first lender. But there is a little bit of an inherent, you're rewarded a little bit by being the one who's advertising, pulled in that client first. if in fact, it wouldn't make a difference for the kid, but for this other gentleman, yes, obviously there were less lending options on that second pull as a result of the impact of that inquiry. So yeah, great questions there. And I think we have gone a ways. I think we're way over for those faithful few that are still with us.
Absolutely. Well, and guys, don't forget about the option to join us for the Becoming a Credit Educator course. We're really excited about being able to provide that for you. Obviously, in the span of this short webinar, we can't cover everything, but James is definitely going to be joining me back for that web shop starting a week from yesterday. Next Monday the 10th is when we're going to start up with that. If you'd like more information about the course and you're not seeing on the website all you need to make the decision about whether it's the right time for you to do that course or not, please feel free to jump in and get a hold of us, ask some additional questions. Otherwise, if you're a past student of that program and you want to re-participate in the new version, go ahead, feel free. Just give us a call. We'll get you set up for that. For those of you who are not already, and James, this would be a good time to go ahead and jump to the affiliate slide. For those of you who want to help your customers, and especially if you're doing a lot of first-time home buyers who have some challenges with their credit, and you get some snapshot of the easy-to-fix 1 or 2 trade line people, but yet you get those other customers that just need a lot of help. They've got multiple lines. There's a lot of confusing information. You need somebody who can really professionally go in and investigate what is really going on in that score. Where are the miscodings? Where are the misrepresentations of the type of credit that are unfairly negatively impacting that borrower's score, and then legitimately, ethically, and accurately, 100% responsibly correct and apply to get the inaccuracies reported. I mean, it goes back to that thing we were talking about with the collections a while back, right? It may have been legitimately that borrower's collection, right? And they may legitimately owe it, and it still may be well within the statute of limitations. But because it's reporting as if it just opened yesterday, because some third-party collection company is fraudulently misrepresenting the original date of delinquency, it's hitting them for 100 points negative, where it should only be hitting them for 10 or 20, right? And that's the kind of stuff that James and his team investigate. That's the kind of stuff that they dig deep into with customers who just aren't equipped to do it for themselves. And if you as a producing originator are overwhelmed by how many customers that you're working with that just aren't quite there and they need that additional layer of help and support, it's not just a 1 or 2 rapid rescore, fix it, and you're done type program, you might want to consider working with these guys at NewScore and getting some expert advice and support to help incubate those leads for you for the future. Other than that, guys, thanks again for joining us today. James, I'm not sure how much more time you have to stick around for a few questions, but
yeah, if anybody has any questions, I'll keep the window open for another 5 minutes or so here. Also, I'm going to do something a little bit different today. I just want to make sure that anybody that has those questions can get a hold of me directly. So I'm going to give you. I've got a new cell phone that I've still got to update on some social media and stuff. So I want you to be able to find me if you look for me here. So my direct number. 469-971-3677. Again, that's 469-971-3677. James C. at newscore.today. So just exactly like it all sounds, NewScore, just one word. Again, James C. at newscore.today. So if you guys have any other questions, and I'll follow up with you with that as well, but there's my number and my email. And I appreciate we had some really good questions today, some good interaction. I love that, and hopefully everybody liked it enough that we'll see you on the credit coaching webinars. So I'm not sure if we lost Eric or not.
Okay, sorry, I had my headset on mute because it's starting to get a little noisy around me. It's getting close to lunchtime here, but anyway, guys, yeah, definitely. Also, guys, if you want to go ahead and post any additional questions to the Q&A log, we're going to leave the platform open for just a few more minutes here. Otherwise, thanks again for joining us for this installment of the Maximum Performance webinar series. We look forward to seeing you guys on the next installment. Be watching the email list for the updates and the newsletters. Check out the website. Also, if you want, go to MaximumCoach.com, and there's a new program you can join free, our new Maximum Growth Membership Program, which will give you access to the entire library of the Maximum Performance webinar series, and a lot of the additional tools and resources that have been provided as part of that resource over the years. Anyway, thanks again, James, for joining us. Any final comments you'd like to leave with the group before we hang up here?
No, hopefully everybody noticed how awesome my new office is and the big Han Solo behind me, and doesn't judge me too harshly for such, and I hope you all enjoyed the webinar.
Have a great time, everybody. We'll look forward to catching you on the next one.